We are going to have, as I say, a quick fire input. What does this all mean from colleagues here? Then go to talk in round tables. And thank you very much for finding your place that is there. For contributors here, only sensible to start off with you, Ben. What does it all mean for the sector?
Okay. Well, and everybody keeps saying, can one be heard? I'm not sure if this is on, but I suppose for me, the first thing...
Do you want to stand up?
Is this any better?
Yeah.
Okay. So the first thing for me goes right back to the very reason for CDFA wanting to commission the research that Nick fed back on, which is that we didn't know. The fact that we do now know at least something, I think is very exciting. Yes, daunting possibly, but for the first time I think it gives us the potential to, and I know it's an oft and rather overused term, but to create a kind of roadmap for how to get to where we want to be. So I think it's exciting. I suppose in terms of the specifics, the finance is startling. That figure of £6 billion is eye-watering in relation particularly to the 200 million that our CDFI members lent last year. There is a massive gap. What do we do about that gap? I guess it feels to me the challenge, our challenge, my challenge as the trade body is to create a completely different kind of financial services industry. It's no longer just about funding. It's about community finance providers being part of the mainstream and having a sort of core partnership with banks, with government, with other emerging investors, where it isn't about funding, it's just about everybody serving the markets that the financial services industry is there to achieve. And that needs incentives. It's not going to happen. There's been some great work. We're doing good stuff with the BBA. There's a bank to CDFI referral scheme that's being piloted. There are some other great initiatives around growth, but we've got to incentivize it through a coherent policy framework. So things like disclosure of lending data, proper tax breaks can take place. And I think it's about socializing the finance sector. The social sector is often told to get its act together and become more savvy and act like the financial sector. Well, maybe what we're talking about here is a root and branch socializing of the finance sector. But the gap is not just about money. There's a gap around the market. So let's just say we did get this £6 billion tomorrow. What would happen? Well, I think the sector would keel over very quickly. We simply do not have the infrastructure to be able to handle that volume. We're going to hear from Angela in a minute, but there's a massive opportunity and need for CDFIs, credit unions, SIFIs, housing associations, money advice providers, the list goes on, to work together under what we kind of view as a community finance partnership. I think we have to create an integrated local infrastructure that is linked by a kind of centralized, really high-tech, efficient support model that Lydia and others referred to earlier on. But the second bit of the market is around people out there, not people in this room, people out there on the street, most of whom will know absolutely nothing about community finance. How do we generate the kind of public awareness, interest, commitment, enthusiasm, just basic consumer demand that's necessary to convert what is need into demand? We know from our very crude, and I think Nick's research has verified this, that CDFIs, the 200 million represents about 9% of what's actually there. So the conversion rate from need into evident demand is woefully low. We've got to mount a big public awareness campaign to achieve that. My last point, though, is a big but, a kind of note of caution. You know, with the excitement of, okay, we can see this growth trajectory, okay, we can see new avenues to getting the money in. Scale, efficiency, we must not lose sight of why these institutions were established in the first place, which is really, I think, about socialising our economy. It is about serving those that others won't serve, and we must not for 1 minute compromise on that.
Thank you very much, Ben. Nick?
Okay, so I'll do the can you hear me thing again. So Nick Temple from Social Enterprise UK, as the name would suggest, we're the national body for social enterprises. In this context, also the policy lead to Cabinet Office on Social Investment, and I chair the Social Investment Forum, which brings many of the leading social investment intermediaries together. I suppose just brief thoughts on kind of both reports, and then some thoughts on the whole thing. From the New Economics Foundation, I think the report on stakeholder banks really brought out to me that the critical bit was about this balance of local and national. I think the trickiness of that balance and how easily it's sent out of kilter, particularly with regulation or different incentives leading people in a different direction, the positives and negatives of those and how we balance those. And I think we recognise that actually from the broader social enterprise sector as well. We're constantly being told, look at these great local solutions, but look at how big the problems are, which is why we kind of constantly hear about things like social franchising and so on, which again is still more talked about than done. But I think that whether there's learning to share about how we achieve that local national balance, I'd be really interested in pursuing. I think related to that is the issue of governance. So yes, accountability and transparency. I was at an event last night where someone talked about radical transparency. This was also the week when I was told I needed to be resiliently dynamic, so it could just be my week for crap buzzwords. But like I suppose on the kind of openness point, it does seem that there's something around helping organisations stick to the social mission, which is what Ben's just been talking about. How do we avoid perhaps some of what happened in the microfinance sector around becoming commercialised, and how some of those have been diverted. So I think what part does openness play in the governance we're looking for, I think, is a critical question. And the final bit that also stood out, I suppose, from that NEF report was the power of that the sector has collectively, both in buying, but also in kind of savings and assets, and how important the deposit aspect was to the strength of those banks. And again, I'm struck by some of the examples we're starting to see in the more mature sectors of the social enterprise world. I was at a meeting with a social enterprise that buys collaboratively for housing associations and uses the savings to fund particular projects or initiatives in those localities of the specific housing association. So combining that national and local, that saved 55 million for the housing associations and created 1,000 jobs and thousands more training opportunities. So there's some interesting stuff going on. I was surprised that Australia didn't really feature so much, but that's
It's a big omission.
Our friends at the Community Sector Bank will no doubt be in touch. And I suppose I'm sure CRA will come up today, so if it has already, then, and I missed it earlier, then apologies. But I suppose for me it felt like that there's still some principles and
just unpack
Community Reinvestment Act. Apologies, assumption that people in the room knew. I think some of the principles of that still apply, and you can see that there's a compelling case made here. But I think we're often told in the UK we're a leader in social enterprise, and our Australian friends always say they have second mover advantage because they kind of watch us make the mistakes and then learn from it. And I wonder whether we can do something similar with CRA, that it's not about importing it wholesale, but it's about learning from some of the best bits. Moving to the CDFA report, I suppose again the section on civil society organisations doesn't come as a big surprise. Our research says access to finance is the biggest challenge for social enterprises. 40% of them are based in the most deprived areas of the UK, so that rings very true, and a lot of them are SMEs, or in fact they put the S in SMEs. So again, that gap clearly identified, and this reinforces that really from our perspective. In terms of the wider social investment marketplace, I suppose it is still nascent and fragmented and difficult to navigate and complex and a bit slow. And I think that the balance of some of the more established CDFIs with some of the newer social investors and how we achieve that. Risk capital is still a big gap, and I think the other bit I know all research always recommends more research as one of its outcomes, but I suppose I would be interested in kind of digging down into what the gaps are in terms of that demand. And I know we're trying to look at that, but also there's other research underway on that. Because crowdfunding community shares may well be much more of a route for a lot of our members than social impact bonds, for example. So something about risk, and the fact that big society capital is not a panacea. It's got a lot of restrictions around it. It's probably got unnaturally high expectations. So again, how do we build a broader sense of what the community and social finance looks like? And finally, just to look at the suggestion of tripartite partnerships in this field, which I was really interested in. Again, I think, if I might say, the sort of indication that mainstream banks are either doing CSR or market development is a bit outdated. I think increasingly, actually, it's at the heart of actually changing their business. So they're actually putting social value at the heart of what they're doing. It's still early stages, but I think that differentiation and segmentation is maybe a bit old, and that does raise opportunities for some of those partnerships with some of the more enlightened financial institutions. The big challenge for me, and that I'll come to for both, is, for me there's a compelling case for action here. There's a compelling case for sector-wide coordination. And partly, someone showed me the other day the graph of doom. I don't know if you've come across the graph of doom. It's hugely depressing. So it's basically the local authority spending, which it will have to do over the next 10 years, which goes up, and which is statutory stuff they'll have to do, and how much money they'll have to do everything else that they'd like to do. And basically that comes down as the spending goes up and there's not much left. And the needs at a local level, we hear anecdotally all the time, are getting larger and larger. So this need is absolutely enormous, not just in terms of the figures. So there's a huge role to play, I think, here, especially in our most disadvantaged areas. And one of the reports says sector associations will need to provide leadership. So I suppose as a sector association, I'm saying, yes, we're happy to provide leadership and work together, I think. I think there's more we can do collaboratively with the community finance sector. The big piece for me is about comms. So how do you get the communications without the scale and losing the locality? How do you compete and reach the big markets, the general public? I don't think we've resolved that in our world, and I think that's a big nut to crack.
Thank you very much. Bruce, over to you.
Yeah, my name's Bruce Davis. I'm down variously on this form as peer-to-peer or Zopa or Abundance. So I'm currently Managing Director of Abundance, which is an FSA-regulated platform that crowdfunds renewables. I helped found Zopa, which was the world's first peer-to-peer site, and I'm an anthropologist that studies money. I guess my response to the report was a couple of things around language, first of all, which is around the idea that there's a mainstream and a margin. I'm not sure it's a useful distinction. I think that there's mainstream banks who are massively subsidised, despite the fact they're apparently so efficient and so effective, but we don't have the same rules applied to the alternative finance sector, which is thriving pretty well without any subsidy, incentive, or otherwise tax or whatever. So at the moment, I think the idea that that's the mainstream and we're the alternative, maybe we need to sort of not make that distinction. There's a financial system, and it's currently not functioning very well because we went through a period where we allowed banks to take over lots of other banks and reduce competition over time. So now we're in a situation where we have 5 banks not competing with each other, because why do they need to? They've got chunky market share, they don't need any more, so they might as well just sit on what they've got. And what we're not doing is encouraging innovation. So I guess my take out from this is there's a massive need for innovation. You've got a big funding gap in terms of people needing credit. But there's another gap, and the gap is, as someone helped found peer-to-peer, who says there's a gap on the investment side too. So Abundance is set up as a commercial organisation, but we have a social goal, and our social goal is financial inclusion. So we allow people to invest from £5 as a minimum investment, which means that anybody can therefore try investing and see where their money goes. And we also, I think the other thing to think about is what peer-to-peer represents. So I think at the moment there's a little bit of a tense relationship between peer-to-peer and other sectors, because we're not quite sure what peer-to-peer is. And is Wonga peer-to-peer, for example, which it isn't. So what's just to clarify, that's something they'd quite like to be, but they aren't. because it somehow makes them nice and social, perhaps. But what is peer-to-peer? Well, peer-to-peer is a really efficient, scalable mechanism for getting people to invest in stuff they want to invest in. That's all peer-to-peer really is. It's a capital market. It's not difficult. It's not complicated. It's not an institution. It merely facilitates money going where it needs to go. And I think what we're looking at here is, have we really got the most efficient mechanisms for facilitating money going from where it is, which is in people's pockets in different places, and that can be small pockets or big pockets, and is it going to the businesses and the bits of the economy that actually need it, as opposed to lending to things which banks feel comfortable with, which is essentially any assets that they can sort of put on their balance sheet as growing, and also, you know, on the other side of the fence, you know, are they lending to stuff that's speculative, which they can therefore charge a higher rent on? So I guess from the peer-to-peer side, what we're looking at, and in terms of crowdfunding as well, is, you know, crowdfunding is about more than just creativeness and equity and risk investing. Crowdfunding, there's abundance. We do debt financing of projects. There's plenty of debt financing crowdfunders out there. So it's not a sort of, this is the only way this model works. I think the whole sector needs to think about how is it releasing the capital that is available to go into the economy, and how effectively is then able to channel it into the places where it's needed. And I think, you know, the idea that banks got where they are by being efficient and competitive, we just throw that out now, because they got where they are by having lots of power and having lots of regulatory capture and essentially controlling it the way they want it to go. And what we need to do is to rebalance that so that these new innovative institutions can take their place. And I think Andy Haldane is right. You know, it won't be so long before we start to see the high street being replaced by these new innovative forms of lending and borrowing that are available to people to do now. And some of them are unregulated, some of them are regulated. That doesn't seem to matter so much to people anymore. But fundamentally what we want to see is, if we want to get more money into the places where it's needed, the best way to do that, I think, and there's a word that keeps going, is the transparency word. You know, if everybody had their money stuck in different banks, knew where that money actually went, they would move their money. They would try and put it into institutions that perhaps were more effective and maybe had different goals, and maybe they would examine their own motives as to why they're putting their money into different places, and be a little bit more reflexive about how their money is being used, and a bit more conscious of the ethics of how that money is used. And I think, you know, this sector represents an interesting opportunity from that point of view, that you can open up that transparency, create that connection. Fundamentally, people will invest in stuff when they know where it's going. And I think what the industry really benefit from is, alternative finance is to increase that transparency, show more how the money is being used. That's the communication job, as much as communicating that you are an institution that can be trusted, etc., etc.
Okay, well, I'm going to stand up, because although most of you won't notice whether I'm sitting or standing, but I want to particularly thank Lydia, actually, because the summary that she gave earlier, although it meant I missed my coffee because I had to reorganise my thoughts, I thought was a really great summary. I'm CEO of a credit union in Birmingham, albeit I was a lifelong banker before that, so I'm trying to get my soul back at the moment. But I was, my background was in business, commercial and latterly corporate lending. And I was appointed CEO of CitySave, which is a very large, diverse community in Birmingham. At the last count, we had 187 separate identified communities within one city. So complex and diverse and needy, amongst many other things, as being wonderful, I have to tell you. I was asked when I was appointed to put in place banking systems. We were hugely loss-making, but I stand here today having turned around from a £480,000 income on a loan book to what's now annualising at £900,000. So I know that credit unions are fundamentally sustainable, and the opportunity and the positive messages that I think came out from what Lydia said, there's such a lot of chicken licking around at the moment, but actually there's an awful lot of really fabulous organisations out there. I won't go into the history of why we're where we are. I think banking remains a key focus, and I was really thrilled that actually there was a lot of chat about actually how fundamental that was. Have to be grateful and sorry to Barclays, but I am because they've helped us with some funding. We're investing heavily in creating banking solutions that are credible, relationship managed, fit for purpose, and meet modern requirements, driving out cost, but actually also really meeting the needs of real people who just want something slightly better. Actually, I have to say, probably returning to my original banking roots in around early 1980s, where you actually had real banking managers and relationship support. But having said that, we've developed apps which allow our partners to actually distribute for us and open accounts. We're working with payees such as housing associations, local authorities and utilities. And it's the base of a business plan that we submitted to the DWP, which, if not successful, we hope at least influences some of the thoughts that really strongly reflect what Lydia talked about as being potential. I also think that we should focus more on the Australian model, because I have to tell you, I think the Australian model shows how quickly you can grow in a few years and how much you can achieve. And we are aiming that the credit union should have 5% of the personal banking sector in 5 years, which is 50% of the gap in the banking sector that's been identified from a range of sources. I do disagree a little bit that I think we have great open and positive dialogue with the FSA, and I think they've been really open to some of the things that we've asked for. I'm really sorry that the rest of my notes then are not very logical, they're just bullet points, so I try and whiz through them so it gives a little bit of food for thought. Our legislation was updated last year, it remains archaic, and it really does need to be enhanced if credit unions...
Can you hold it closer to your mouth?
So sorry, yes, okay. I'm usually quite loud actually, people complain about the opposite, so we are campaigning on lots of levels that credit unions need a more supportive framework, not necessarily losing the common bond that makes us very special, but actually allowing us to step into different areas. There's a lot of chat about commercial lending. We do now have the legislation. As I say, my concern would be that I don't think credit unions at this point have the skills, so I'm not sure whether we step into that sector yet, albeit I do think that personal lending type, handyman type loans, certainly quite easy for us to move into. One of the things about having a shared service centre is maybe we could do things like a business lending unit and some sort of working, but it's also a great area where, certainly in Birmingham, we work very closely with Aston Reinvestment Trust, who are a fabulous CDFA in the city, so I know there's a lot of cross-working going on there. In terms of personal lending, I think I've got a couple of things I would add. I think in the past 10 years, personal lending has changed. We don't use credit cards and overdrafts the way we did, and every quarter I watch the Bank of England lending stats, but the fall in what personal lending they report is really being offset by the growth in utility, rent and mortgage arrears. What I'm sad about in the last 10 years is that that kind of arrears doesn't seem to carry the same stigma. It seems to be just a regular feature, but those are very limiting. That's not cheap borrowing, that's really, really limiting on people's life choices. And is something that we have to think about when we look at what lending and where it sits. Personal debt has changed in the last 10 years. I would also say that certainly in my city and what I see, the growth in high cost lending is partly fuelled by capital issues faced by banks and whatever, but I also think that it's equally fuelled by very aggressive and over promotion of very easy and not responsible lending from high cost. I think they're creating a self-created sector in places just by promoting how easy it is to get money. I'm very interested in Japanese research in terms of when they clamp down on that sector, and I hope this year we'll see a clamp down on that sector, and I hope it will have the impact that it had in Japan here. But I also hope, so I can't find direct links, but I hope it may also stem the massive growth in the £10 billion a year gambling industry that's just growing at the most extraordinary rate, especially amongst the under 25s. So we have a few proposals that we're really campaigning hard on. We believe everybody should have a simple savings plan or access to it through their income, and that should be a legislative right the same way that a pension is going to be. Because if people, and I'm passionate about credit unions, but the access to small savings plans would mean people don't have to borrow £50 or £100. Sorry.
I lost you.
Did you?
Have a simple asset.
A simple savings plan directly from your income, so that the day you start work, you're asked, well, that's your income, how do you want to save £5 a month or whatever? The access to a small savings plan through legislation, in the same way that pensions are becoming legislative, would actually overcome a lot of emergency issues that people have where they need to borrow £50 very urgently. We also agree treasury solutions. Bizarrely, credit unions are very cash rich, although our lending book has grown considerably So in my savings, every time we set up a loan, we also ask all of our members to set up a savings plan. So my blooming savings are outgrowing faster than my lending, which might make most of you go, oh, that's a good person to talk to. But I have legislative reasons why I can't then lend that to anybody else. And so it sits with Barclays and all of our other 4 bankers that we use, and we use our deposits as widely as we can, but it goes into the banking sector. When I sit with people like this, there should be another opportunity, I'm sure, and that's something we're campaigning for, a mutuals type facility, a bit like the interbank facility. Not sure I should mention Barclays and interbank in the same bit, but I'm not going to go any further with that because I do love Barclays, I really do. Lending is very easy, but lending very well isn't. So I did just want to make that point, that just because there's a gap, I'm not sure that we should fill it. And that really was all of my points.
Great. Thank you very much indeed. So you've had some excellent input there on those initial presentations that that we've had. We've had tweets coming in as well. John Waters, the need for a stakeholder bank meta system seems to need to be recognised implicitly, not looking at all the right places. Alison Seabrook is present, so we need will across all sectors to respond. Parity Trust, huge amount of campaigning is needed as well. Now we're going to move to table discussions. We have also had some additional input that's been worked up by the 4 partners, initial partners in the Community Investment Coalition, in the form of a working paper. And I think probably what we will take some kind of key elements of that from any of those involved. I don't know whether Pat Connaughty or Louis or someone else would like to do that, but I think we'll do that after the roundtable discussions. And this really now is an invitation for you to look at this issue about ambition. I think Bruce's kind of words are a helpful reminder that actually the margins to mainstream is kind of self-marginalising yourself to start with, in a sense, and actually we can understand this in mathematical terms as a gap. We can understand it in innovation terms as the way that the world is moving. Either way, there are complex sets of challenges that are needed. Framework changes, policy, regulatory changes, infrastructure has been talked about, confidence, kind of public engagement, all of these kinds of areas. So really, it's over to you now to look through these, and I'd like to invite you to try to identify what you think are the key areas and steps for a community investment coalition to be focusing on. Maybe ideas, maybe things you're working on or you think others should work on, but that actually could benefit from a unity of purpose and an integrated effort to try and push those. We will run up